post the Brexit vote. And of course, last Friday we saw a lot of very, very awful price action, not just in European banking stocks, but also in US banking stocks. And it's sort of a double whammy right now, considering the lack of confidence and all the uncertainty around the Brexit, corporate and economic growth slowing, and of course a low interest rate environment that doesn't look to be changing anytime soon. To be quite frank, it's nothing new. We've seen most of those points. I think the only new thing here that's weighing on the banks is the UK Brexit vote. So the reality of low interest rates that are going to remain lower, the Fed is not going to raise rates anytime soon, and the reality of economics global slowdown is very much now just kind of hitting home for a lot of folks, including bank analysts who are finally waking up to this reality. So let's have a look at the charts. Let me show you guys what I'm talking about in specific, what kind of trades are setting up.
Okay guys, so let's start looking at the banks through the KBW Bank Index. BKX is the ticker symbol. If for some reason you're not familiar with it, I would certainly highly encourage you to watch that index on a consistent basis. Banks are extremely important to follow all the time. So in 2015, we had sort of a last hooray rally, so to speak, that didn't end too well. You can see as we got into the second half of 2015, things started falling apart. Now, there were a lot of clues underneath the surface, which is why I've been very cautious for banks from a tactical or I guess a structural perspective, I should say, really since the second half of last year. And a lot of it has to do with yield. You can see the yield down here in the 10-year treasury market. So this is the longer, or I guess, mid to longer end of the curve, has consistently been making a series of lower highs, even when we had a rally into November of last year and another rally, of course, this spring into May or so. Yields continue to go lower, and to me that was a clue not to chase those stocks higher. Now there were trades to do along the way, and you can probably find something where I did a bullish trade in things like Bank of America in May or for a quickie, but structurally and tactically, I guess there's been no reason to be long financials. So let's look at this again through real classic technical analysis 101. You've seen yields very clearly, I should say, have been signaling this entire dynamic that there was no reason to chase these banking stocks higher. So let's look at this a little more simply. Again, just looking at the chart, we can draw some very simple lines of previous support like this. You can see we essentially came into resistance here in May, and sure enough, at that point, the Fed became dovish again after being very hawkish for a few weeks. Very, very silly, but that's exactly what happened. There was a lot of technical analysis stuff as well. Besides just simple resistance line that came into play here, you can see we had measured from the 2015 top down to the lows in February, we had an exact 61.8% Fibonacci retracement. And so from my perspective, if the banks want to continue to be weaker for the next following, couple of quarters or so, then for sure the next downside target is the February lows for the BKX in the mid 50s. And beyond that, I would not be surprised to see the high 40s. Okay, now that's not my best case, but that's entirely feasible based upon this major rejection from technical aspect that we've seen in the BKX. Don't have to just look at the BKX. You can look at some single name stocks like Bank of America that look very, very similar. Really the same deal here. There's really no reason to make this more complicated than it needs to be. You can see what used to be support became resistance back here in April and again in May, and we've been pushing lower ever since. So to me, this is a real classic bearish setup here that even though I don't think you necessarily have to chase this market lower right now, but you can see that the trend here probably is going to be lower again for the foreseeable future. We had a very classic rising wedge pattern of sorts. All of this came together here in the April and May period, and that really was a time to be a seller of banks from a structural or tactical perspective, regardless, but depending on your time frame. So that's what we did, and I still think there is plenty of downside here in Bank of America as well. I think Bank of America can easily get back into the low teens. So there you have it, guys. I hope this makes sense.
As always, follow me on Instagram, instagram.com/steadytrader.